Listen closely. What you think you know about Bitcoin right now is wrong. Pay attention, because ignoring this could cost you more than you imagine. Price is loud, structure is quiet, and this video is about the structure. Let's start at the beginning. Not the beginning of this crash, the beginning of the cycle. Because to understand where we are on February 16th, 2026, you have to understand where we were and how we got here. And that requires a certain willingness to zoom out, which is, ironically, the hardest thing for a human brain to do when it is experiencing financial pain. In April 2024, Bitcoin went through its fourth halving. Every 4 years, the protocol cuts the rate at which new Bitcoin is produced in half. In 2024, the block reward dropped from 6.25 Bitcoin per block to 3.125. Think of it like a mine that produces gold at a set rate, and someone comes along and installs a restrictor that permanently reduces how much gold comes out forever. That supply shock does not hit the market immediately. It takes 12 to 18 months to fully propagate through miner economics, exchange reserves, and institutional positioning. This is not theory. It has followed this pattern 3 prior times, and it followed it a 4th time. In October 2025, Bitcoin reached $126,198. That is not a coincidence. That is a mechanical outcome of supply and demand interacting over time. Now, here is where the behavioral finance becomes important. When prices rise to extraordinary levels, 2 things happen simultaneously. Conviction in long-term holders starts converting to profit-taking, and new participants, attracted by headlines and social proof, enter the market at or near the top. The first group is rational, the second group is emotional, and when the first group exits, the second group experiences the full weight of declining prices without the benefit of accumulated gains to cushion the psychological blow. This dynamic, where early holders distribute to late entrants, is not unique to Bitcoin. It is the oldest pattern in financial markets. It showed up in Dutch tulips in 1637. It showed up in railroad stocks in the 1880s. It showed up in technology shares in 1999 and 2000. Human psychology has not materially changed. Only the asset changes. The pattern stays. But here's what most people miss about this particular cycle. The correction we are experiencing in early 2026 is structurally cleaner than almost any prior Bitcoin correction. In 2022, we had the collapse of Terra Luna, an algorithmic stablecoin that erased $40 billion in market value in 72 hours. We had the bankruptcy of Three Arrows Capital, one of the largest crypto hedge funds in the world. We had FTX, an exchange that turned out to be using customer deposits as a personal investment vehicle. These were not market corrections. These were systemic frauds unwinding in real time. The 2022 bear market had skeletons. Bernstein Research's Gautam Chugani said something important recently, and it deserves to be quoted with context. He wrote that the Bitcoin bear case is the weakest in its history, and that nothing broke, no skeletons will show up. Whether you agree with his bullish price target or not, that structural observation is correct. The plumbing of the Bitcoin market in 2026 is intact. What broke in early February was price. What did not break was infrastructure. So what actually caused the crash? Because calling it a crash without explaining the mechanics is exactly the kind of surface-level analysis that leaves investors making poor decisions. There were 5 distinct pressure systems converging simultaneously, and understanding each one separately is the only way to understand them together. If you're new here, this channel is built around one idea: that serious capital decisions deserve serious analysis, not panic, not hype. Context, data, and clear thinking. If that sounds useful to you, consider staying and subscribing. What we do here is not predict, what we do is understand. The first was long-term holder distribution. The people who bought Bitcoin between 2010 and 2015 at prices between $100 and $500 had been sitting on generational wealth for over a decade. When Bitcoin reached $126,000 in October 2025, many of them made a rational decision to rebalance. Bitwise's chief investment officer Matt Hugin was direct about this. The primary selling came from early Bitcoin holders taking profits after extraordinary long-term gains, combined with over-leveraged positions that had built up throughout the bull run. These sellers were not panicking. They were executing a financial plan. The problem is that when the largest, most convicted holders in a market begin distributing, the effect on price is significant because the buyers absorbing that supply are predominantly newer market participants with shorter time horizons and less conviction. The second pressure system was leverage compression. Throughout 2024 and 2025, as Bitcoin rose, traders increasingly used borrowed capital, leverage, to amplify their positions. Open interest, which is the total value of outstanding derivative contracts in the market, had reached historically elevated levels by late 2025. When an asset's price begins to fall and leveraged positions lose value, brokers issue margin calls. If the trader cannot add more collateral, the position is automatically closed. That forced closing pushes the price down further, which triggers the next margin call, which causes another forced close. According to CoinGlass data, over $2.5 billion in long and short positions were liquidated in a single week during the February 5th event. That is not selling driven by fundamental reassessment. That is mechanical. It is a pressure valve releasing. And once the leverage is cleared from the system, the selling pressure associated with it disappears almost entirely because it was never real conviction selling in the first place. The third was Bitcoin's increasingly tight correlation with U.S. technology equities. Bitcoin now moves in approximately 93% correlation with the S&P 500, particularly with the technology sector. When Microsoft reported earnings that disappointed and the broader tech sector experienced a sell-off in early February, Bitcoin moved with it. This is uncomfortable for people who believe in the digital gold narrative. Gold does not correlate with tech stocks. But Bitcoin, at this stage of its institutional adoption, is still priced primarily as a risk asset, a speculative instrument that benefits from loose financial conditions and suffers when those conditions tighten. This is not a permanent state. It is a transitional one. But we must be honest about where we are in that transition, not where we would like to be. The fourth was tax-driven selling. The IRS introduced Form 1099-DA in 2026, requiring all crypto brokers to formally report transactions. For the first time in the asset class's history, U.S. investors with crypto gains from 2024 and 2025 received formal tax notices. Many of them needed liquidity to cover those liabilities. February is precisely when this pressure peaks, the period between when tax returns are being prepared and when payments are due. This selling was quiet, dispersed across millions of accounts, and almost entirely ignored by mainstream crypto analysis. But it was real, and it was additive to all the other selling pressure already present. The fifth was the Kevin Warsh announcement. On January 30th, President Trump nominated Warsh, a former Federal Reserve governor and known monetary hawk, to replace Jerome Powell as Fed chair. Markets fell 6% in a single session on the news. The reason is not complicated. Warsh has publicly stated that Bitcoin and many crypto assets represent speculative excess. His policy framework favors higher real interest rates and a smaller central bank balance sheet. Higher rates mean money costs more. When money costs more, investors tend to pull capital from higher risk, longer duration assets. And Bitcoin, whatever its long-term potential, is still priced in markets as a higher risk, longer duration asset. The market's reaction was not irrational. It was pricing in a less supportive monetary environment. 5 separate forces, all arriving simultaneously. The result was a 52% decline from an all-time high. And now the question the market is wrestling with, imperfectly, emotionally, noisily, is whether this is a temporary correction within a larger structural uptrend or the beginning of a prolonged bear cycle. Let me tell you what the ownership structure says, because ownership is the deepest signal in any market. BlackRock's iShares Bitcoin Trust holds 771,000 Bitcoin. During the February sell-off, the ETF's assets under management fell from $130 billion to approximately $97 billion. Retail investors read that as institutional exit. It was not. Of that $33 billion decline, approximately $7 billion represented actual outflows, redemptions by investors who chose to leave. The remaining $26 billion was purely price-related. The Bitcoin did not move. The price of the Bitcoin moved. That distinction matters. It means over 93% of BlackRock's Bitcoin ETF holders, through one of the sharpest declines in recent memory, held their positions. That is not the behavior of a panicking investor base. That is the behavior of an investor base with an appropriate time horizon. Strategy, formerly known as MicroStrategy, holds 714,644 Bitcoin, representing approximately 3.4% of the total Bitcoin that will ever exist. They purchased it at an average price of $76,056. At today's price of $68,605, they are sitting on roughly $4.5 billion in unrealized losses on paper. And during the crash, not before, not after, they purchased an additional 1,142 Bitcoin at 90 million. Michael Saylor appeared on financial media and said directly, "We're going to be buying Bitcoin every quarter forever." This is either the most committed long-term conviction in modern corporate finance or the most dangerous capital misallocation in recent history. The market will eventually render a verdict, but the directional signal is unambiguous. Satoshi Nakamoto's wallets hold an estimated 968,452 Bitcoin. Not a single Satoshi has moved, ever. This supply is not available to markets. It does not respond to price. It represents a permanent structural scarcity that is written into the protocol and will remain regardless of what happens to price. Global governments hold approximately 305,000 Bitcoin, primarily seized assets from criminal cases held as financial instruments. El Salvador holds 6,274 Bitcoin as part of its national reserve strategy. The United States government holds a significant position, through seized and forfeited assets. These positions have not been meaningfully liquidated. They represent sovereign-level conviction in the asset's continued relevance. If you're finding this level of structural depth useful, this is the kind of analysis we build here consistently. If it helps you think more clearly about your capital, consider subscribing. Not because of a button, but because the next piece of context we cover might be the one that changes how you approach a future decision. Now let's talk about what is happening beneath the price right now, because the February 6th accumulation data is not an isolated event. It is part of a pattern. On that day, whale wallets absorbed 66,940 Bitcoin into accumulation addresses, the highest single-day whale accumulation since 2022. The following week, wallets holding more than 1,000 Bitcoin added 53,000 Bitcoin, worth over $4 billion at then current prices. ETF inflows, which had been negative for weeks, turned positive. $371 million entered on Friday, $145 million on Monday. These are not retail flows. These are institutional decisions with multi-quarter time horizons attached to them. The mining network's hash rate, the computational power securing the Bitcoin network, reached an all-time record of 1.15 zettahashes per second during the same period that price was declining. Miners do not expand infrastructure when they expect an asset to go to zero. They contract, they sell rigs, they exit. The opposite is happening. The people who must make forward-looking capital decisions about Bitcoin's future, miners who stake physical machines and electricity costs on their view of price, are more committed today than at any point in the network's history. This is the gap between price and structure. Price said panic, structure said accumulate. But let me be careful here, because this is exactly the moment where analysis can tip into advocacy. And this channel does not advocate. Let me tell you what the risks are, because they are real, and they deserve to be spoken clearly. The Warsh confirmation process is a live risk. His hearings will take place in the coming months, and if his comments about crypto are replayed in a political context, sentiment could deteriorate further. Rate policy expectations will shift with each inflation data release, and Bitcoin, correlated to risk assets, will move with those shifts. A CPI print that comes in above expectations could send equities lower and Bitcoin with them. The leverage mechanics are also not fully resolved. While $2.5 billion in positions were liquidated in early February, open interest has rebuilt somewhat as price has recovered to $68,605. If Bitcoin fails to hold the $70,000 level convincingly and begins declining again, a second cascade of forced liquidations could occur. Ed Engel at Compass Point has flagged $55,000 as a possible retest level under adverse conditions. Stephen McClurg at Canary Capital has stated directly that he expects $50,000 as a possible cyclical low by summer 2026. These are credible institutional views from credible institutional analysts. They should not be dismissed because they are uncomfortable. And there is the question of what happens to Strategy if Bitcoin extends its decline. The company holds 3.4% of the total Bitcoin supply, purchased with a combination of equity raises and convertible debt. At current prices, they carry approximately $4.5 billion in paper losses. Their balance sheet, according to Saylor, contains sufficient liquidity to sustain their position without forced selling. But sufficient is a word that changes meaning as price moves. Markets are aware of this exposure, and that awareness creates a reflexive relationship. If Bitcoin falls and Strategy's position comes under pressure, the market's fear of Strategy selling may itself contribute to downward price pressure, regardless of whether Strategy actually sells. This is not a fatal risk, but it is a structural one that sophisticated observers track. Now let me give you the three conditional scenarios that serious analysts are modeling, not as predictions, but as probability-weighted frameworks for thinking about capital allocation. The first scenario is structural continuation. In this outcome, the February capitulation event, characterized by the $10 billion in realized losses recorded during the worst week, the fear and greed index reaching 5, and the subsequent whale accumulation, represents the cycle's exhaustion point. Historically, when that index reaches extreme fear levels coinciding with massive realized loss events, it has marked either the final stage or a stage very close to the final stage of a correction. In this scenario, Bitcoin consolidates in the $64,000 to $75,000 range through February and March, builds a base, and begins recovering in the second half of 2026 as Warsh, despite his hawkish framing, faces economic conditions that require rate flexibility. Bernstein Research has this scenario producing a Bitcoin price of $150,000 by year-end 2026. That is their view, not a universal consensus. But their reasoning, that the structural foundation of Bitcoin is stronger than at any prior cycle, is serious and should be engaged with seriously. The second scenario is range accumulation. This is arguably the most likely near-term outcome regardless of the long-term trajectory. Bitcoin spends the first half of 2026 oscillating between $60,000 and $75,000, frustrating bulls and bears in equal measure. Institutional inflows continue at a steady pace. Retail interest remains suppressed. The 4-year cycle plays out according to historical pattern, a period of low volatility accumulation before the next major directional move. This scenario requires patience and benefits investors who are dollar cost averaging, spreading their purchases across time rather than attempting to find a single entry point. The mathematics of dollar cost averaging are straightforward. If you purchase the same dollar amount at $68,000 and again at $60,000, your average cost is $64,000. Volatility in this framework is not your enemy. It is a mechanism that lowers your average acquisition price. The third scenario is a liquidity shock. In this outcome, a combination of adverse macro conditions, inflation reaccelerating, aggressive rate hikes under Warsh, a significant tech sector correction, or an unexpected geopolitical event pushes Bitcoin through the $60,000 support level with momentum. The forced liquidation cycle triggers again. Prices approach $50,000 to $55,000. Strategy's paper losses deepen. Sentiment collapses. This scenario does not represent Bitcoin's failure as an asset. It represents the worst historically typical correction from a cycle high, a 60 to 65% drawdown, which is actually mild compared to the 85% drawdowns of 2018 and the 77% drawdown of 2022. But it is painful, it is possible, and investors who have not sized their positions appropriately for this outcome will find it very difficult to hold through. Here is the rhetorical question worth sitting with. Why do most retail investors lose money in assets that ultimately go up? The answer is not bad timing. The answer is position sizing. When someone has 80% of their investable assets in a single volatile position, a 40% decline in that position becomes existential. It threatens their ability to pay rent, to cover emergencies, to function financially. And so they sell, not because Bitcoin's long-term case changed, but because their personal financial situation forces the decision. The asset was fine, the position size was not. This is why every serious analyst and every serious portfolio manager repeats the same fundamental advice, not because it is interesting, but because it is true. Invest only capital with a 3 to 5 year time horizon. Never use borrowed money. Size positions so that even a 60% decline does not force a decision. Write your investment thesis before you put capital in, and write the conditions under which you would exit. If you have not done that, the market will write those conditions for you, usually at the worst possible moment and usually at the worst possible price. Let me take a moment to zoom out historically, because context is the single most underrated tool in an investor's arsenal. People who experienced 1929 did not understand it as a generational buying opportunity in hindsight accessible equities. They experienced it as the end of prosperity. The Dow Jones fell 89% between 1929 and 1932, and then it recovered, fully. And then it went on to one of the longest bull markets in history. The 2008 financial crisis felt, to the people inside it, like the end of the global financial system. The S&P 500 fell 57%. Major financial institutions required government intervention to survive, and then it recovered, and then it went on to produce the longest bull market in U.S. equity history. Bitcoin's prior cycles follow a structurally similar but mechanically distinct pattern. The 85% decline of 2018 felt, to people in it, like the end of the asset class. Every credible financial institution was saying cryptocurrency was worthless. And then Bitcoin went from $3,200 to $69,000 by 2021. The 77% decline of 2022, accompanied by genuine systemic fraud in the form of FTX, Luna, and Three Arrows, felt, to people in it, like confirmation that the skeptics were right all along, and then Bitcoin went from $15,000 to $126,000 by October 2025. The lesson is not that Bitcoin always goes up. The lesson is that the emotional experience of being inside a large correction is consistently different from the analytical reality of what is happening to the underlying structure. The structure in 2018 was not broken. The structure in 2022 had legitimate fractures from fraud, but Bitcoin itself, the protocol, remained intact. The structure in 2026 is, by any honest measurement, stronger than it has ever been. ETF infrastructure is established. Sovereign and institutional holdings are real and meaningful. The mining network is more secure than at any point in its 17-year history. And retail sentiment, which is a contrarian indicator, is at levels of despair not seen since cycle bottoms in prior years. None of this is a guarantee. The word guarantee has no place in serious investment analysis, but it is context, and context changes decisions. If this kind of structural thinking is useful to you, if it helps you step back from the noise and see the architecture of what is actually happening, consider subscribing to this channel. We cover macro, liquidity mechanics, and capital flows consistently, and we do it without asking you to be either terrified or euphoric. There is one more thing worth discussing before we reach the conclusion, and it is perhaps the most important observation of all. What this market correction revealed, quietly, for those willing to look, is that Bitcoin is undergoing a fundamental identity transition. For years, the dominant narrative was digital gold, a store of value, a hedge, an asset that rises when everything else falls. The data in early 2026 challenges this narrative directly. Gold is up 61% over the past 12 months. Bitcoin is down 40% over the same period. That gap is not a coincidence. It is a measurement. It tells you that at this moment in time, market participants are treating gold as a defensive store of value and treating Bitcoin as a risk asset, something to hold when conditions are favorable and sell when conditions tighten. But here's the nuance that the headline misses. Bitcoin's correlation with gold is also, over longer time frames, approximately 91%. The short-term divergence we are seeing reflects positioning, where investors chose to reduce risk exposure, more than a fundamental verdict about Bitcoin's long-term properties. As Bitcoin's institutional base deepens, as sovereign adoption expands, and as the derivative leverage that currently distorts its short-term price action is progressively regulated and constrained, the correlation with tech equities will likely compress. The correlation with gold will likely strengthen. This is not guaranteed, but it is the logical directional arc of an asset transitioning from speculative instrument to institutional reserve asset. The K-shaped nature of the current crypto market provides a signal here. While Bitcoin experienced significant outflows during its worst weeks, Ethereum ETFs saw 14 million in net inflows during the same period. XRP ETFs saw $20 million. Solana saw $1.2 million. Capital is not leaving the digital asset ecosystem. It is rotating within it, from the most liquid and most oversold asset toward instruments where institutional ETF vehicles are newer and institutional positioning is less crowded. This rotation is not a bearish signal for Bitcoin. It is a maturation signal for the broader market. As the ecosystem deepens, the flows become more differentiated, which is exactly what you see in every maturing asset class. Now let me bring this together into something you can actually use. Not a prediction, a framework. The immediate price range that most institutional research desks are working with for February is $64,000 to $75,000. Within that range, the $70,000 level is the most important resistance. Bitcoin needs to close above $70,000 with conviction, not touch it and retreat, for momentum to shift. The 200-day exponential moving average sits at approximately 68,130, which is almost exactly where Bitcoin is trading today. This convergence is not a signal to buy or sell. It is a signal that the market is at a genuine decision point and that the next directional move will be meaningful. On the downside, $60,000 is the level that must hold for the February low to represent a cycle bottom. If $60,000 fails, Canary Capital's $50,000 target comes into play as a realistic intermediate outcome. This would represent approximately a 60% decline from the all-time high, severe but within historical norms for a post-halving correction. On the upside, $84,900 to $90,000 represents the medium-term target in a scenario where buyers regain structural control. Beyond $100,000 in the near term, within the next 6 to 8 weeks, most serious analysts are assigning a probability below 10%. But over a 12 to 18-month horizon, that calculation changes significantly if monetary policy shifts and the structural accumulation we are observing continues. Here's the thing about time horizon. It is the single variable that separates profitable from unprofitable participation in volatile assets, more reliably than any other factor. Investors with a 1-month time horizon looking at Bitcoin today are looking at uncertainty, risk, and possible further decline. Investors with a 1-year time horizon are looking at an asset sitting 46% below its all-time high, being accumulated by institutions, governments, and the largest corporate Bitcoin holder in history, with a mining network at record strength and a halving-driven supply constraint working in the background. Investors with a 3-year time horizon are looking at a pattern that is repeated 4 times, each time producing a new all-time high, in an asset whose total available supply will never exceed 21 million units. Same asset, same price. Completely different risk profile depending only on time horizon. This is the insight that the noise machine will never give you, because the noise machine runs on urgency. It profits from your engagement with today's price, not your clarity about long-term capital positioning. The more time you spend checking the price, the more emotional your decisions become. And the more emotional your decisions become, the more likely you are to buy high and sell low, which is the defining characteristic of retail participation in every asset class in every era of financial history. There is one final thing I want to say about Bitcoin's position in the evolving global financial system, because this matters for how you think about it as an asset, not just as a price. The U.S. national debt now exceeds $36 trillion. Annual interest payments on that debt approach $1 trillion. The global debt supercycle, The decades-long expansion of sovereign corporate and household debt relative to GDP has not reversed. It has accelerated. In this environment, the long-term case for assets with fixed supply and no counterparty risk does not weaken. It strengthens. Bitcoin is not the only asset with these properties. Gold has similar characteristics, but it is the only one that combines fixed supply with programmable transferability, transparent on-chain verification, and a decentralized network secured by more computational power than any other system on Earth. This does not make it a risk-free investment. There is no such thing as a risk-free investment. It makes it a structurally coherent response to a world where sovereign debt is expanding, where currency debasement is a documented policy tool, and where the existing financial infrastructure has proven, in 2008 and repeatedly since, that counterparty risk inside the traditional system is real and not always visible until it is too late. Bitcoin is not a lottery ticket. It is not a retirement plan by itself. It is not a shortcut. It is a 17-year-old asset that has survived multiple 80% plus declines, multiple regulatory attempts at suppression, the collapse of its most prominent exchange, the imprisonment of its most prominent promoter, and the consistent prediction of its death by some of the most credentialed voices in traditional finance. And it is sitting today on February 16, 2026, with $97 billion in U.S.-regulated ETF assets, government holdings across multiple sovereign nations, a corporate treasury strategy at the largest publicly traded company to ever adopt it, and a mining network at all-time record strength. Whatever the next 6 months bring, that is the structure. That is the thing beneath the price. And understanding the thing beneath the price, rather than reacting to the price itself, is the difference between an investor and a participant. The people accumulating 66,000 Bitcoin on the most fearful day of the year understood something. They understood that the asset and the price are not the same thing. They understood that fear is not analysis. They understood that conviction without leverage is one of the most powerful positions you can hold in a volatile market because it removes the possibility of forced selling at the worst possible moment. If that framework resonates with how you want to approach your own capital decisions, this channel is built for exactly that kind of thinking. We do not do hype cycles. We do not forecast exact prices. We do not tell you what to buy or sell. We give you the structure, the ownership data, the liquidity mechanics, the macro context, the behavioral framework, and we let you make the decision that is appropriate for your specific financial situation. If that is valuable to you, subscribe. Not as a gesture, as a decision that this kind of analytical framework is worth following over time, because the market will do what the market will do, February will end, March will come, the Warsh hearings will happen, the inflation data will print, the leverage will rebuild or it will not, the ETF flows will continue or they will reverse, and at every inflection point there will be noise, enormous, urgent, emotionally compelling noise, and beneath it there will be structure. Focus on the structure. Size your positions appropriately. Write your thesis before you invest, and write the conditions that would invalidate it. Hold your time horizon with discipline when the price tries to compress it. And remember that every major accumulation opportunity in this asset's history has felt, from the inside, exactly like this. Uncertain, uncomfortable, and full of credible voices explaining why this time is different and why the bottom is not in. Sometimes those voices are right, sometimes the bottom is not in, but the investors who approach those moments with clarity, with appropriate position sizing, and with a written plan consistently outperformed those who approach them with emotion, regardless of whether the bottom was exactly where they thought it was. Clarity is more valuable than certainty. Discipline is more powerful than conviction. And patience in a volatile asset with a structural long-term case is not passive. It is strategic. That is the situation on February 16th, 2026. Not a guarantee, not a prediction. A framework built on data, delivered without drama, because that is the only kind of analysis worth having.